The tech stocks have obviously been in a bit of a bubble. I mean, you just have to look at some of the stories you're covering this morning to say that although there seem to be some bright spots, they're mainly because we've seen so much liquidity put into the markets. The rest of the news is pretty poor. Results coming out have been generally poor, generally not as expected. There are some hopes, as we saw with the Ryanair earnings. They're a little bit better than maybe the bears had expected, but you'd expect some sort of surge in the second quarter. I'm pretty sure now that we're going to see a form of double dip, if only for the reason that you said Hong Kong. We've had another surge. We've had restaurants closed today, for instance. This is the third time we've had a tightening of restrictions. And the virus is going to pop back from time to time in certain clusters. And I think sooner or later that's going to spook the markets.
So the position on equities at this stage is what? Hold fast or reduce exposure?
Well, I've generally been reducing exposure over about the last month because, we were surprised that equities moved as they did. The fall back in March was very sharp, and it wasn't surprised to see a jump when we saw the Fed come in with so much liquidity. But it really has gone a long way. And my general feeling is, overall, I kind of like my equity portfolios. They're quite nicely balanced. They are tech heavy. They've done okay there. But I think it's wise maybe to take 10 or 20% out of your equity holdings, if only because it just reduces your exposure to any uncertainties that are on the horizon.